Okay, fun seekers, have we got a presentation for you? Yeah, we are going to try to get our arms around this huge industry with its 12,000 different mutual fund offerings by looking at the various major categories. As we'll see at the very end of the presentation, there are dozens of them, and no one is going to ask you to remember all of them. But there are some very large groups that we want you to be familiar with. And so we strongly urge you to go to the Canvas or website and print out a copy of the mutual fund types Scramble sheet. And you can listen to the commentary here, but that's what this presentation is all about. So get a copy of this thing. I did my best, and I'll explain it as we go through the presentation, to try to show you what you're up against with the Scramble sheet. And I tried using some serious software where I could do it all electronically and get the letters to go around certain things, and I failed miserably, so I just did it by hand. My apologies. So let's start on slide 41, and we're going to go from the riskiest mutual funds to the least risky. Okay, so keep that in mind. And of course, the riskiest mutual funds will be stock funds. Now, there are one or two categories that are even more riskier than what we'll look at. And you might see Pro and Ultra or Momentum. I'm not big fans of these. Remember Janus 20, which was buried because it did so poorly. The most riskiest category that we'll discuss, and the one I hope you, for the most part, stay away from, except for a tiny little piece of your portfolio, and that is the aggressive growth funds. Aggressive growth funds. These are highly speculative, and what do we know about the word speculative in the investment world? Yeah, gambling. Highly speculative mutual funds that seek large profits from capital gains. Folks, they're rolling the dice. And you know what? They may do very well over time, and they may crack and fall and dissolve into a pool of tears. Well, we know they will. We just don't know when. We know there's going to be times when aggressive growth is going to fall precipitously, 50, 60, 70%. And so I'm going to use an analogy, and you know what? If it works for you, great. If not, just ignore it. I'm going to think of a buffet because I really like to eat. And when you go to the buffet table, do you fill up your plate with hot jalapeno peppers, all the very, very spicy spices? No, you put a little bit of spice on your plate. And so for those of you who are younger and more inclined toward roller coaster rides, put a little bit of your portfolio in aggressive growth funds. What happens is, again, as we said, investing is simple, but it ain't easy. You're sitting in that 401k plan, and you're looking at the options that are available, and you'll see this aggressive growth fund and whatever it's called. I'm not sure the name, it depends on the company you're dealing with. And it will have eye-popping returns over the long term. But what they don't show, they don't show the risk. They don't show the standard deviation because nobody understands it. And so, you might be sitting next to somebody who says, well, hey, look at this thing. It's done 13% over the last 10 years or 14%. That's where I'm going to put all my money. Ooh, are they ready for the times when invariably it's going to fall 50%? They better be, because it's going to happen. And that's when emotions take over. Ooh, is it too late to get out? And so they take everything out at the worst possible time and move it into the money market because someone told them they can't lose any money in the money market, and just in time for the market to come back. So that is why we want to temper your enthusiasm And maybe, you're happy with an aggressive growth fund falling 50, 60%. Remember, your $1,000 will become $500. Your $10,000 will become $6,000. Your $100,000 will become $55,000. Okay. And as we said, there are some that are even more aggressive than these aggressive growth funds. The next category are the growth funds. These are mutual funds whose primary goals are capital gains and long-term growth, typically by investing in high-growth companies. So, what's the difference between aggressive growth and a growth fund? Well, it can be very squishy. It can be very subtle. You have to dig deeper. In the prospectus, which of course you're all going to read, we're going to ask you to read one, it'll say something along the lines of, this fund will strive to be at least 80% invested in growth companies, something like that. And they'll usually eschew, not a zapato shoe, but they'll avoid words like aggressive or trading or speculation. These are middle of the road growth funds. And so they're spicy, yes, but not, 4-alarm spices. All right, so that's the second category. Now we're going to get weird. Slide 42. You will also, slide 42. You will also see another category called capital appreciation funds. Now, these are mutual funds that seek long-term growth of capital. Well, wait a minute. How does that differ from a growth fund? Well, as we said, most growth funds will have a provision that states that they will invest primarily in growth stocks. What are those? We'll discuss those more in Chapter 3 when we get to stocks. Usually staying between 80% and 100% invested in the market. Whereas a capital appreciation fund can often invest in anything they like, anywhere they like. So they don't have to invest in what are called growth companies, growth stocks. They could invest in what are called value stocks or cyclical stocks or defensive stocks. And what are all these titles and categories mean later, Chapter 3. In general, they tend to be as risky as growth and aggressive growth funds, but not always. And so if you look at the Scramble sheet, you'll see I tried to draw capital appreciation around the aggressive growth and the growth funds. And again, I tried to do it electronically and I couldn't figure it out. And so we like to use the term, they paint with a broad brush. They don't necessarily look at companies that are on the cover of GQ and Vogue and Vanity Unfair with the beautiful teeth and gorgeous bodies, the growth stocks that are in the news all the time. No, they might look at a company that's beaten down, that all the people stay away from, where the manager believes there's opportunity for capital appreciation. You see the subtle difference? The well-known Fidelity Magellan Fund, which we will refer to Mr. Peter Lynch later on in the semester, is a capital appreciation fund. Okay. You want to see what you're up against? One of the nation's oldest and largest growth funds, capital appreciation funds, is called the Growth Fund of America. Right. But they're a capital appreciation fund. And if you went to the managers of the Growth Fund of America and say, well, why don't you call yourself the Capital Appreciation Fund of America? They would say, excuse us, please. We were the Growth Fund of America before these categories were even developed. We were just called the Growth Fund of America when the idea was to, grow your capital, grow your money, grow your investments. So this is what you're up against. And that's why in the Scramble sheet, if we go over to the Scramble sheet, you'll see I've tried to roll capital appreciation around aggressive growth and growth. Do your due diligence. Dig deeply into the funds you're interested in. Now, the next category is my personal favorite, and it is called growth and income. Well, when we talk about stocks, we talk about growth, right? We want the companies to get bigger, we want the stock to do well, but we also love to discuss dividends because companies optionally may, they don't have to, distribute their earnings in the form of dividends. You can think of them like interest payments, but they're not. They're legally different. And so companies, the Growth and Income Fund is looking for companies that are growing the capital, growing the company, but also paying us dividends. So these are mutual funds that seek both long-term growth and current income with typically a primary emphasis on capital gains. Sometimes they may, they may own bonds to augment the income when the managers feel that that there's not a whole lot of dividends to be had, so they might try to get some income from bonds where that is interest. What you'll often hear people or use the term, they'll say that these are a blend funds. They'll call them blend funds of growth and value. Now, what are growth and income funds? With regard to our analogy or metaphor of a buffet. This is the main dish. This is the entree. This is the meat and potatoes, the pasta. This is what you should have, in my humble opinion, at least 40, 50% on your plate. I'm a big fan of growth and income because, yes, we want growth, but we also want dividends. And what we're going to find, dear students, next chapter is that some of the best long-term investments in stocks have been companies that have paid dividends and have grown consistently their dividends over decades. So if you were to be asked on an exam, maybe for example, what mutual fund you would want in your portfolio, hint, 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 you would make your professor, your instructor, very happy by choosing at least one growth and income fund. Okay. Now, again, we're going to get weird because what happens is growth and income funds often get lumped into what are called value funds. Ooh, and that's why on the Scramble sheet, you see we have growth and income. Where is it? Growth and income. And we have this value and blend here wrapped around it. The problem with value is that it is a term that is used in the industry in a way that not necessarily means value, in my humble opinion. And we will discuss this in detail when we get to stocks, one of the problems of putting mutual funds before stocks. So these are mutual funds that seek stocks that are undervalued in the market by investing in shares that have low PE multiples and high dividend yields. In other words, these are companies that are out of favor with investors. And so you'll hear people say, he's a strong or a deep value investor. The problem is, as we'll discuss in detail in the next chapter, is that most of us, when we hear the term value, we think of something that it's worth something to us. And a growth stock might be a good value. It might not be a good value. A beaten down stock might be beaten down for a very good reason. So be careful. And again, this is the subtleties that we're going to uncover, kind of like an onion, pulling back the layers as we dig deeper and deeper into the subtleties of investments and investing in general. But just remember, growth and income funds, pasta. Meat and potatoes, the main entree. The next category of stock funds are called equity income funds. Now, I didn't make this name up. I wish somebody would have asked me first. I would have called them stock dividend funds because equity is another name for dividends. Equity is another name for stocks, and stocks pay income in the form of dividends. So wouldn't it be nice if they called them stock dividend funds? No, they call them equity income funds. These are mutual funds that emphasize current income and capital appreciation by investing primarily in high-yielding, income-producing common stocks. In other words, companies that are boring. Railroads, food companies, utilities, real estate investment trusts. There you get, real estate companies. They're not growing very fast. You don't see them on the cover of GQ with the famous, Teslas of the world and the Apples and the Facebooks of the world. No, food companies. I mean, how much more Cheerios can people eat? But they pay good dividends, and they have a tendency to stick around when everybody else is falling into doing a face plant. And so these companies are very boring, and when the market's zooming ahead, they're going to sit in the corner and kind of just be boring. But then when markets go down, they shine. Equity income funds will also invest in bonds to generate income when the investment advisor believes that stock prices have risen to levels that threaten preservation of capital. Notice that the first categories we've seen so far haven't said anything about preservation of capital, have they? No, they know they're going to go down. And so when the market goes down, they know they're going to go down. The equity income funds will go down also, but typically far less than their aggressive growth and income cousins. Why is that? Because dividends don't lie. Dividends are always a positive, and companies that pay dividends and have paid dividends for decades tend to be far more stable than the growth-oriented companies. Many equity income funds did very well during the 2000 to 2002 bear market. Why? Because some of you weren't even alive yet, but they were investing in what was pejoratively called at the time old economy funds. We wanted new economy funds like telecommunications and internet and computer software and programming and the old economy funds. Nobody wants to. I remember Woman. This is 1998 thing. Who would invest in a REIT in 5 years? All the shopping centers will be closed down. I didn't say anything. She was a client, wasn't my client. I just kind of smiled and said, well, yeah, things are changing very quickly, aren't they? But not that quickly. They held up very well during the 2000 to 2002 bear market because all of a sudden people looked around and after AOL dropped 90%, America Online, you ever hear of them? The utilities and railroads and food companies held up very, very well. Every type of fund was clobbered in 2008. But in 2008, when the aggressive growth funds fell 60, 70%, the growth funds fell 50%, the growth and income funds 40%, the equity income funds only fell about 30%. Doesn't sound like much, but do the arithmetic. Instead of your $10,000 becoming $3,000, your $10,000 became $7,000. Oh well, that's part of investing in stocks. So those were the first categories that we took a look at. And so now what we're going to do is we're going to overlay 2 more categories to make life interesting. Make sure you've got that mutual fund scramble sheet handy. There are large cap, mid cap, small cap stocks. Now, what's this? It stands for capitalization, and we're going to learn how to compute it in Chapter 3, but in reality, all we got to do is go on the internet and look it up. It tells you if it's a mama bear, a papa bear, or a baby bear. Now, which do you think is the riskiest? Well, typically small cap stocks are the riskiest. Why? They just don't have the wherewithal. They don't have the resources to weather storms in the economy. Large caps companies, many of these companies they're name brand companies. A lot of them you don't. They do have the resources to weather the storm, and of course mid cap are somewhere in the middle. Interestingly, though, when the economy turns around, small cap stocks tend to do much better. Why? Because first of all, they got beaten down harder. Plus, they're more nimble. They're more able to take advantages of new opportunities. So in general, large cap are going to be the least riskiest out of the 3. Small cap, the most riskiest, and mid cap somewhere in between. And then on top of that, we're going to overlay what is called domesticity. Where do you get your mail? And we talked about this, right? Domestic means based in the U.S. International means based outside the U.S. and global is in todo el mundo, right? Everywhere in the world, United States and outside the United States. Now, 50 years ago, 100 years ago, it was just generally regarded that inside the United States, domestic were far less risky than outside the United States. But you know what? It's just not true anymore, folks. There are companies based outside the United States that have better um, accounting standards than companies based inside the United States. And there are companies outside the United States that do a majority of the business inside the United States, and companies inside the United States that do the majority of business outside the United States. So it's not as a big a distinction as it used to be. Okay, so we got those categories. We started with the riskiest to the least riskiest, and then we added large cap, mid cap, small cap, the size of the companies, and then we added where they're based. And so what has happened, if we take a look at the mutual fund scramble sheet, is it's become a combination and permutation problem. Pick one from column A and one from column B and one from column C. And so now what do we have? We have a domestic small cap aggressive growth fund, or we have a global large cap growth fund. And if you've taken statistics, you'll know that the permutations can grow exponentially. And that's one of the reasons why we've run into 12,000 mutual funds. Because if one mutual fund company has a domestic small cap aggressive growth fund, then their competitors say we have to have one too. So you see what you're up against? Yeah, it's part of mutual funds. The hardest part of mutual funds is deciding which one or two. You don't need that many, folks. They're already diversified. And then on top of that, we were going to get into more, what can you use the word balkanization, breaking things up, into regional. There are mutual funds that just invest in Japan or Canada or the Far East, Latin America. There used to be a mutual fund that just invested in companies in California. Can't find it anymore. I think it's gone. But hey, California is 5th or 6th largest economy in the world, right? And then emerging markets with India, Mexico, Brazil, Russia, the Philippines, China, Turkey, South Africa. Yeah. Or sector funds. Mutual funds that just invest in an industry or a sector of the economy, such as energy, or energy exploration, or energy processing, or technology, wireless, or computer manufacturing, or healthcare, drugs, or hospitals, or you can just continue to subcategories and subcategories and subcategories. And in my humble opinion, these are, well-intentioned, but why? What were the two major reasons we invested in stocks? Mutual funds. Invested in mutual funds. Diversification and professional money management. By focusing on a region or the emerging markets or a sector of the economy, we are concentrating. And you know what? Again, if you think of it like a buffet, maybe put a little bit. You know that things are hopping and popping down in Latin America because you travel there often. Okay, put 5-10% of your portfolio in a Latin American fund. Certainly, in my humble opinion, the emerging markets are the next world growth engine. But in the meantime, sometimes they're called submerging markets. Right? They're very volatile and can just disappear, like what happened to Argentina lately. So, for the most part, my humble opinion, you stay away from these, except if you know something about the energy world or something about the telecommunications world or whatever, put a little bit in. Now, if anybody tries to sell you a market timing fund, or they say, hey, we use these market timing strategies in our fund, just stay away because it's dumb, folks. Nobody can time the market. The only people who can do it are liars. And often they're lying to themselves to think they can do it. And they're certainly lying to you. Whether they're doing it intentionally or not, I'm not sure, because I think a lot of these people really do delude themselves into thinking they can time the market. Look, you want to time the market, you got to do it. You got to be right twice. It's hard enough to be right once. You got to know when it's going to fall, and you got to know when it's going to come back. Yeah, if you get one of them right, you're darn good. If you get both of them right, you're superhuman. Or you just might be lucky. And then next time it fails miserably. So you got it, folks? That was the stock world. And that is our left side of our scramble sheet. Now let's take a look at the bond world. And we're going to do basically the same thing. We're going to start from the riskiest bond funds to the least riskiest and then overlay categories on top of that. And so, Payano, you told me that bonds are not that risky. Well, certainly they are less risky than stocks, but bonds can fall also. They did in 2022. And they will again in the future, but far fewer times. You have to go back to 1994 when bonds had a meaningful drop. And you have to go back to 1969 when bonds and stocks both fell at the same time. Mutual funds that invest in various kinds and grades, meaning the quality of the bonds, with income as the primary objective. Now, there is a category of bond funds called high yield, high income. They're really called junk bonds, and we'll discuss junk bonds in more detail when we get to bonds. But these are companies that are in distress. So if your credit score is bad, guess what? You go to the bank, they're going to ask you to pay a high interest rate. Well, the same thing is true for companies and some municipalities, but not the federal government, at least not yet. They're going to have to pay higher interest. So with higher interest, higher return, you get higher risk. And it turns out that these high yield bond funds tend to follow stocks more often than they follow the bond market. And why is that? Well, again, we'll discuss that later when we get into the details about bonds. But just know that these are the riskiest bond funds. And for my humble opinion, again, little bit on your plate if you're so inclined, but for the most part, I'd stay away from them. The next category are the corporate bond funds, which usually are very high quality companies. Most everybody pays their mortgages. Most everybody pays their car loans. Well, most all corporations pay their debts. We'll discuss the rating scale that bonds have when we get to bonds. But these are high quality companies. Some of them have what are called convertible bonds, which sound exciting, kind of like a convertible car, but not really. And then the next category are the municipal bonds, state and local governments. Now, some of them are insured, which is a nice little feature to have. But if you're going to get an insured bond fund, what are you going to get? Right, less return, right? Less risk, less return. And so you have to take that into account. Now, what's cool about muni bonds? Well, we've sort of alluded to this. We're going to allude to it again, and we're going to again when we get to bonds and look at the details. But municipal bonds typically are free from federal taxes. There's a few exceptions, but for the most part, when you buy a muni bond, you do not have to pay federal taxes on your interest income. If you buy a muni bond from your state, and for us, we would look for a California muni bond fund, we would not only not pay any taxes to the federal government, the state of California would say, hey, cool, you invested in California, we will waive, W-A-I-V-E, the taxes on the income tax on your state tax return. So that's why these things are very popular with high net worth individuals, high income individuals who pay a high interest rate. High tax rate. They're going to get a lower interest rate, but after taxes, it turns out to be a higher interest rate than, say, a comparable corporate bond. So we'll discuss this in detail when we get to bonds later on in the semester. But we want you to remember this. Muni bonds, free from federal taxes. And if you buy a muni bond in your state, free from state taxes. And then the next categories, they're often lumped in together, are the U.S.-backed bonds and the U.S. government bonds, treasury bonds. Now, these U.S.-backed bonds are not explicitly backed by the United States government. They are sometimes called mortgage-backed bonds. These were sponsored by the Congress. You might have heard of Fannie Mae, Freddie Mac, and it's not a candy company, Fannie Mae. They are in the mortgage industry, basically. And that's why they're called mortgage-backed bonds. And chances are, if you have a mortgage, it's actually owned, even though it doesn't look like it to you. You're sending your check to Wells Fargo or Mission Federal Credit Union or whatever. But behind them is Fannie Mae or Freddie Mac, they're actually the ones who are put up the money for the mortgage. And so they have this implicit guarantee that if they fail, the United States government will come to the rescue, and that's exactly what happened in 2008 and 9. And then, of course, the granddaddy of them all, the Treasury, government securities funds, government bond funds. Notice that they are free from state and local taxes. This is something that's in the Constitution. The feds can't tax the state and local governments. That's why municipal bonds have tax-free. IRS doesn't like tax-free. They like the word tax-exempt, whatever. You don't have to pay federal income taxes on your muni bonds. And you don't have to pay state income taxes on your government bonds. That's part of the Constitution. So we've gone on our Scramble sheet from the high-yield junk bonds, corporate, muni, U.S.-backed, and U.S. Treasury, from the most riskiest to the least riskiest. And now, just as we did with stocks, we're going to overlay two more categories. Well, the one category is the same as it was with stocks, domesticity. Where are they based? Most people are going to stick with U.S. bonds, but there are global bonds and international bond funds that may pique your interest. That's up to you. And we'll discuss investing outside the United States and what are some of the problems with that and some of the things we have to worry about. But here's the tricky part. Long-term, intermediate term, short-term bond funds. Now, wait a minute. Long is kind of like large and short is kind of like small and intermediate is kind of like mid. Isn't this the same as? No, it's a totally different thing, folks. This is the maturity. When do the bonds mature? When do you get your money back? Long-term bonds turn out to be riskier. Why? Well, when you think about it, it just makes sense. If you lend your money out for 30 years, as opposed to 3 years, there's a whole lot more that can go wrong in 30 years than 3 years. So long-term bonds are going to pay a higher interest rate typically than shorter-term bonds. And they're going to exhibit more risk, more opportunity for return, but more risk. Short-term bonds are going to look similar to money markets and CDs and the like because you're going to get your money fairly soon, 2-3 years. And intermediate term are going to be somewhere in the middle. So again, as we had with the world of stocks, we have this pick one from column A, domestic, one from column B, long term, and one from column C, high yield junk bonds. And then all the various permutations and combinations thereof. See what you're up against? So those were the bond funds. Now, the next category is quite an interesting category, and in fact, it's a one near and dear to my heart, especially as we get older, and that's the balance fund. Balance funds, folks, have been around for decades. In fact, this American balance fund has been around in one form or another since 1937. How's that for a generic name? The American Balance Fund. These are mutual funds whose objective is to generate a balanced return of both current income from bonds and stocks and long-term capital gains from stocks. So they invest in both stocks and bonds. And typically what you're going to read, hear about is the 60-40 split. 60% stocks, 40% bonds. But the allocation can change as the investment advisor changes. Now, what you want when you are searching for a balance fund is you want a balance fund that definitely is balanced. And this is one of the examples is the American Balance Fund, one of the nation's oldest balance funds, managed as the complete U.S. investment program of a prudent investor. I love that word, prudent. What they say in the prospectus, it says, look, folks, we are never going to be more than 75% stocks, 25% bonds. And we will never be less than 50% stocks, 50% bonds. So they will keep that balance. No matter what's going on in the industry, they might say, stocks are really expensive right now. Let's Let's lower our allocation to stocks and add more bonds, or vice versa. Stocks are a screaming good deal. Let's up our allocation to stocks and bonds. But what they won't do is what you see on slide 49. They will not be what are sometimes called asset allocation funds or strategic balance funds. You got to be careful. You have to read carefully. These are mutual funds that spread investors' money across stocks, bonds, and money market securities. Look, they're similar to balance funds. However, the investment advisor often more diligently tries to fine-tune the allocation as market conditions change. Whereas, as we said on the previous slide, a balanced fund is usually going to stay around 60-40. The asset allocation fund might try to move all their money into cash. Oh, stocks and bonds are going to fall. Or they might move all their money into stocks or move all their money into bonds. This, in my humble opinion, is timing the market timing. Whether they acknowledge it or not, I'll never forget the representatives from our... This was a long time ago, folks. Late 2002, pretty much at the bottom of the market, of the 2000 to 2002 bear market. And the gentlemen from Nationwide on Your Backside were discussing their asset allocation fund, saying that, we're completely into cash, 0% bonds, 0% stocks. And I knew, that wasn't the only clue that I got. We're near the bottom. Maybe we're already at the bottom. We're near the bottom when these people who are not very bright are putting all their money into cash. That usually means they believe the market's going to fall. It's already fallen 50%. It's already fallen 50%. Ooh, is it too late to get out? Yes, it's too late to get out. And how's the time to get in? And indeed, we had hit the bottom October 2002. We didn't know that then. And then there was a little jump up and then hit another bump. Didn't go down as far, but in March of 2003 is when it finally hit the lowest point and then started going up. So stay away from these asset allocation funds, in my humble opinion. And how to determine whether they are an asset allocation fund, you have to read. You have to ask questions. You have to dig deep. Now, you might be saying, well, Payano, you said we're going to go from the riskiest to the least riskiest. Why are you putting balance funds and their poor relation cousins, asset allocation funds, after bonds? Well, interesting question. Theoretically, when you mix stocks and bonds, you should get a portfolio that is actually less risky as measured by standard deviation than a pure stock or a pure bond portfolio. That doesn't make any sense. It does when we get later on in the semester we talk about portfolio allocation and diversification and correlation. In theory, that's the case. In practice, not always so. So, in my humble opinion, a balanced fund is great for people once they get older because we live a lot longer, and we'll discuss this in detail later on. But also for people who are just literally terrified of stocks, and you can't get them to think about a stock mutual fund. You say, well, here's a balance. This invests in stocks and bonds. And they kind of go, all right, maybe we'll do a little bit of that one. Because they're 23 years old, and they got a whole lot of time left, but they're terrified, whatever, their friend lost everything playing the market or whatever. So I'm a big fan personally of balance funds, especially for people as we get older. Because even people in their 60s now, statistically, they have another 20, 30 years left. That's a long time. Slide number 50. The last category, and to review, is money market mutual funds. Money market mutual funds, usually just called money markets, are mutual funds that invest in short-term money market instruments, as we discussed in Chapter 1. Much the same as money market accounts at the banks and the credit unions, except what's the difference? Money market mutual funds are not guaranteed by a corporation, Federal Deposit Insurance Corporation, the National Credit Union Association. No, they are not guaranteed. And there are a few flavors of these general purpose, which invest in treasury bills and commercial papers. There are some that only invest in treasury bills, government securities. And then there are some that are tax exempt. How do they pull that off? Well, they use municipal bonds that are very short term, that are about ready to mature in 6 months. Look, folks, as we've said, they are essentially as safe as a guaranteed money market account at a bank. They invest in the same securities, but they are not explicitly guaranteed. Of course, when the organic matter hits the ventilating device, as it did in 2008, and one or two, in this case, two mutual funds, money market mutual funds, broke the buck. Just type in breaking the buck into any search engine. And what happened? The whole world gets, oh no! And these people with trillions of dollars, a few $1 trillion in these money markets decide we better get these things into the bank. And then, of course, it creates a run, and it's not a good thing. And so what happened? The Federal Reserve Bank came to the rescue and said, we will make sure that all money market mutual funds are liquid. And so they did that for 6 months, starting in September 2008, and then again did it for another 6 months until the September of 2009. And by that time, people were still very, very worried, but at least they weren't running to the bank trying to get all their money out of the bank, or running to their money market mutual fund trying to get all their money. Where are they going to put it? I don't know. So these are the least risky mutual funds. And so that is what we have here on our Scramble sheet, right? And what we want you to get a feel for is what are you going to do, right? What are you going to do when you're in that 401k meeting and you see all these different mutual funds? What some people do, as we've made mention, is they will move everything into the aggressive growth fund because that's the one that's done the best over the last 10 years or whatever. Or they're terrified and they'll put everything in the money market mutual fund because their friend told them that's the only way that they won't lose any money. And what we try to get them to go somewhere in the middle, right? Come on, it's not so bad, I remember one client, she's adorable, and she had been putting $50 a month away for 2 months. And the market, this was 2002, of course. She called me, what do we do? The market fell again. What do I do, Frank? I said, well, how much money did you start with? $100. And what is it down now to? What's it now? It's $98. So how's it feel to lose $2? And she said, oh, it's on the phone. Not bad. I said, yeah, right. You want to know how much I lost? It's part of investing, right? You got to be ready intellectually, which is what you're doing now. Thank you very much for taking our class. But emotionally, I'm not going to sugarcoat it. There are going to be times when, and people all say this. It feels like somebody punched me in the gut. I lost 30%, whatever. But that's the time to buy more. Wrong. I don't want to do that. Are you kidding? No mas. But that's the way investing is. If you invest in stocks for the long term, it's going to happen. So now what we hope you'll do, folks, is, and we're going to discuss this in subsequent presentations in chapter 2, is take a look at the long-term results. What happens if you put money away for 30 years, 40 years, 20 years, 89 years, 88 years? Not too many people have an 89-year time horizon. But you're going to see that there are going to be times when you lose money. Okay, let's continue. On slide 51 are mutual funds of mutual funds. Well, you know what had to happen, right? Well, actually, these things are not a joke. They are very popular. And why is that? Well, because of the employer-sponsored plans, the 401ks, the 403bs that we've discussed. They are sometimes called lifestyle funds. That's what the thrift savings plan, the federal government's 401k plan calls them. Target date, target retirement. You choose the fund that matches your time horizon. I'm going to retire in 2050 or 2060, or my kids are going to go to school in 2030, college 2030. The mutual fund will then populate the mutual fund with other mutual funds, typically in their company, that match the time horizon. As the time horizon shortens, the mutual fund will change the mix of mutual funds. So they will do the asset allocation for you. And some are very good and some are not so good. This is what we'd expect. My beef with them is they tend to be too conservative. People, even in their 20s, in my humble opinion, if you're 20s, you shouldn't have any bonds. Now, that's my opinion. Other people say, no, you should have some bonds for when the organic matter hits the ventilating device and everybody's panicking. The bonds are going to help create ballast. They'll kind of be like your airbag, if you will. They're going to inflate and keep you from losing a lot. But if you're educated and understand that this is going to happen and emotionally prepared for it, so be it. You're going to do better, in my humble opinion, over the long term, but that's why there's chocolate and vanilla and some people like strawberry. Other of these mutual funds are called target risk funds. You choose your risk tolerance. I'm an aggressive growth investor. I'm a conservative income investor, and they will choose the funds for you. So be prepared to see these in your 401k, and of course your assignment. One of your assignments is to look at the Thrift Savings Plan, the federal government's 401k plan, which is actually a very good plan in my humble opinion, and research the lifestyle funds. These are the mutual funds of mutual funds. Slide 52. Now, there are various dozens, hundreds, I'm not sure if there are thousands, but there are a lot of them, specialty funds, sometimes called boutique funds or exotic funds. And my humble opinion is just stay far away from these things. First of all, the first category is not legally a mutual fund. It's called a hedge fund. They traditionally were only open to sophisticated investors. Now, what does that mean? Look it up. Accredited investors, sophisticated investors. These are people who could lose $100,000 and they wouldn't be destitute. They'd, okay, well, I made a mistake, but I lost $100,000, but I'm okay. There's no regulatory oversight. They've become a major force in the economy and in the industry, and they have sky-high fees. They take 1% to 2% operating expenses, which we've already seen how that works, and they often take 20% of your profits. Some are incredibly powerful and have made tremendous sums of money for their investors, and many of them just fall into a pool of tears and dissolve, and you get 1/3 of your money back or whatever. Just stay away from these things, folks. Once you are a sophisticated investor and you don't mind losing $100,000 or $70,000 or whatever, go ahead, take a look at a hedge fund. But for the most part, stay away from them. The next category of boutique specialty funds are bear funds. Now, these are funds that try to make money when the market goes down. The problem with this is, as the global economy, has grown over the last 200 years, the stock market has gone up 3 or 4 years for every 1 year it goes down. So when the year that the market goes down, these things shine. They look like geniuses because everybody else is losing money. They're making money. But when the market's going up, oh boy, do they get clobbered. I saw one person describe it as being bathed in acid because the strategies employed to make money when markets go down are very dangerous. And I would stay far away from these things. We'll discuss precious metals and hard assets. There are mutual funds that actually invest in gold for you. If you really do want to invest in gold, take a look at sector funds, mutual funds that invest in gold miners. Not the gold itself, but we'll discuss gold later on. There are mutual funds that invest in real estate investment trusts. They're another type of sector fund that we talked about. And real estate investment trusts are actually very cool, and we'll discuss those later on when we get to real estate. The problem is there's just not that many of them, so you're very, very concentrated. But it's a way to be a landlord without having to deal with tenants. A way of investing in real estate without having to come up with the tremendous sums of money they want you to put up when you buy real estate as an investment. And then there are just dozens and dozens of these boutique exotic funds, folks. The stock car stocks funds, what do you think they invested in? NASCAR, right. I have a hard time believing this, folks, but the national spectator sport that garners the most people going to the to the in person is NASCAR. 100,000 people on a Sunday afternoon go to the track and watch people drive around at 200 miles an hour in a big circle. And what do you see? Sponsorships, right? Advertising. So the stock car stocks funds invested in companies that were advertising on NASCAR. The Pause Tombstone Fund. What do you think they invested in? Well, mortuaries, cemeteries, caskets. Yeah, everybody's going to die. And thankfully, so did the Pause Tombstone Fund. And then, look, folks, you cannot make this up. Look it up. If you don't believe me, look it up. There was a mutual fund called the Chicken Little Growth Fund for people who were afraid that the sky was falling. There was a fund for good Christians called the Timothy Fund, a fund for good Muslims. The choices are endless, and so are the fees. And then we come to socially responsible funds, which, folks, have been around for decades. They started as mutual funds that refused to invest in companies that sold tobacco or alcohol. That was, since the 1920s and 30s. And then in the 1960s, they moved to companies that polluted or built weapons or nuclear power plants or destroyed the rainforest. And then the companies that exploit labor. It's surprising there are any companies left to invest in. But now the buzz term is called ESG, environmental, social, and governance. And we could spend a ton of time, folks, talking about this because it is, it's politically charged now. But these are very important issues, and they are ignored at your peril or at the peril of the mutual fund companies. But trying to marry all three, because they're moving different parts. I mean, what does environmental have to do with social? It has to do with the governance of the company. Some companies score well on one scale, not so well on the other scale. And some of the companies that you would think would score really poorly need to be included in this. The oil companies, the coal companies, and the like, because they have to be part of the solution. We can't just ignore them, unless everybody just stops deciding to drive or wants to start taking cold showers in the dark. And so you have to be careful when you discuss this ESG and the like, because it's politically charged and it's a difficult issue. But as we said, mutual funds that are aware, I'm not going to use the term woke, need to take these into account. And for all the silliness aside, many socially responsible and ESG funds have actually done quite well for their investors. Why? Because it turns out that high-tech companies tend to score well on these socially responsible ESG scores. And of course, they've been doing well the last 20 some odd years as technology takes over more and more of our lives, he said into his computer using the internet. Slide number 54. Socially irresponsible funds. What? Possibly as a backlash to socially responsible funds and their perceived political overtones, there's a mutual fund called the Vice Fund. Oh yes, you guessed it, folks. It invests in tobacco and alcohol and all the other corporate nasties that you can think of, gambling, defense firms. They've changed the name a few times. I don't know why. They obviously weren't trying to bury the evidence, but they just keep changing the name. It's still a very small fund with high annual fees, but it's managed to keep afloat now for 20 some odd years. So congratulations to the Vice Fund. Check it out if you don't believe me. You can't make this stuff up, folks. You just can't do it. And then Morningstar. Discussion of the different types of mutual funds without discussing Morningstar is a little bit of a bad thing to do, in my humble opinion, because more than not more, but along with the explosion of mutual funds, Morningstar was responsible for a lot of the explosion of mutual funds, and they sort of fessed up and said, "Oh, we're sorry, but we're still going to do what we do." They created what was called the style box, and now it's ownership zones. So they've tried to make it a little bit better. But you see what they did? They said, "Look, is your mutual fund investing in large, medium, or small companies, or are they investing in value, blend, or growth companies?" And so what investors felt they needed to do was tick off all the boxes. I need at least 9 mutual funds for each one of these boxes. And some companies just rebelled and said, forget it, we're not going to do that. Other companies said, okay, if we're going to have to compete in the world, we're going to have to do this. So when they designed the style box, I think they weren't quite sure that this was going to happen. Unintended consequences. They didn't think it was going to happen. They were just trying to categorize the mutual funds. And so they took a little bit of mea culpa, we're sorry, and they've upped it to ownership zones. And they say they're better than the style boxes. I don't use them personally. I I like large companies. I like growth and income, and that's how I categorize my favorite mutual funds. So you can find these ownership zones in their portfolio tab, and you can find them, the old style boxes, in finance.yahoo.com. And so check it out if you are so inclined. But I'd stay away from the darn things. And then finally, as of January 2023, on slide 56, here are the dozens and dozens and dozens of categories as defined by Morningstar. Again, we're not going to ask you to remember all these, but what you should see interspersed in there are variations of the major categories that we've discussed this past hour. Yeah, this is what you're up against. So, dear students, please, as we said with the share classes and the different types of ways that you're charged for mutual funds, the fee structures, we want you to internalize, we want you to memorize, we want you to study these major categories of mutual funds. So that if somebody said, what is this equity income fund? I don't understand. You can say, oh, those are mutual funds that invest primarily in companies that pay dividends. Equity means stock, companies. Income from stocks is dividends. Make sense? I hope so. Study hard, bring honor and glory to Southwestern Community College, to your friends and family and coworkers. We are so proud of you. When we come back, we will review a great debate that is going on in the industry now concerning passive management, index funds, and active management. Mutual fund managers with the top hats who do their best to buy the best stocks, the best bonds, and beat their respective indices. It's yet another politically charged debate that's going on. Everything these days is politically charged. See you in our next presentation, dear students. We are so proud of you. Thank you so much for being in our class.